Bitcoin is pumping again. In just a few days, Bitcoin climbed roughly 20%, pushing toward the $80,000 mark. And suddenly the headlines are back. Bitcoin is back. The bull market is back. Maybe this time it goes to $100,000. But here's the question almost nobody asks. Who actually makes money when Bitcoin pumps? Because when Bitcoin rises, money doesn't magically appear. Someone buys, someone sells, someone collects fees, someone provides the infrastructure, and someone is sitting on billions of dollars of Bitcoin that just became more valuable. This week, U.S. spot Bitcoin ETFs attracted roughly $1.6 billion in net inflows from Monday through Thursday alone, including about $606 million on Thursday. The Wall Street Journal. Bitcoin has also surged more than 20% this week, according to market reports, reaching above $79,000. But here's where the story gets interesting. The biggest winners may not be the people buying Bitcoin today. They may be the people who positioned themselves before everyone else arrived. And to understand where the money is going, we need to follow the Bitcoin, not the hype. The money, level 1. The first people, getting rich, the holders. Imagine you bought Bitcoin years ago. You didn't need to predict today's price. You simply needed to survive the volatility. That is one of the most powerful characteristics of Bitcoin. A person who bought during extreme pessimism can suddenly see their wealth explode when demand returns. And that is exactly what happens during a major rally. Bitcoin's supply doesn't suddenly increase because millions of people want it. The supply schedule is fixed. The 2024 halving reduced the mining reward from 6.25 Bitcoin per block to 3.125 Spark. So when demand accelerates while new supply remains constrained, price can move violently. That's economics. Limited supply, increasing demand, higher prices. But there is a darker side. The people buying today are paying much higher prices than the people who accumulated years ago. And this creates one of the oldest wealth transfers in markets. Late buyers chase momentum while early holders gain liquidity. That doesn't mean every early holder sells. Many don't. But even if they never sell, their paper wealth can increase dramatically. And that brings us to the next group, the people selling access to Bitcoin. Level 2. The billion-dollar toll booth. Gold has miners. Oil has drillers. Stocks have exchanges and brokers. Bitcoin has an entire financial ecosystem built around it. And every time billions of dollars enter that ecosystem, someone collects a toll. Think about the Bitcoin ETF. Most investors aren't opening a wallet. They're not protecting private keys. They're not running a mining operation. They simply buy shares through a traditional brokerage account. That sounds simple. But behind that simple purchase is an enormous financial machine. Asset managers, custodians, market makers, exchanges, trading firms, and infrastructure providers. The result? Bitcoin has effectively been connected to Wall Street's financial plumbing. And when demand explodes, that infrastructure can become extremely valuable. Coinbase is one example. The company doesn't need Bitcoin to rise from $70,000 to $100,000 to have a business. It makes money from the activity surrounding the asset. More trading, more institutional activity, more custody, more transactions, more opportunities to collect fees. Then there are the ETF managers. Their business model is even more interesting. They don't need to correctly predict every Bitcoin move. They manage enormous pools of capital. If assets under management grow, the fees generated from those assets can become substantial. This is one of the oldest lessons in finance. Don't always sell the gold. Sometimes sell the shovel. But there's another group that literally produces the Bitcoin, and their business is getting much harder. Level 3. The Bitcoin miners are playing a brutal game. Bitcoin mining sounds simple. Computers solve mathematical problems. The network rewards successful miners with Bitcoin. But the reality is closer to an industrial arms race. Mining companies need specialized machines. They need enormous amounts of electricity. They need cooling, land, data centers, financing, and cheap power. And after the 2024 halving, the economics became even more difficult. The block subsidy was cut in half. Yet the machines didn't suddenly become cheaper. Electricity didn't become free. Competition didn't disappear. CoinShares reported that Bitcoin miner economics became extremely challenging in early 2026, with hash price falling toward roughly $28 to $30 per petahash per second per day at one point. CoinShares. That means miners can be operating gigantic facilities while fighting for razor-thin margins. So why keep doing it? Because when Bitcoin rises sharply, the economics can change very quickly. A Bitcoin mined yesterday is worth more today. And companies that control enormous amounts of efficient mining capacity can suddenly see their assets become more valuable. But something even more interesting is happening. Some miners are realizing that their most valuable asset may not actually be Bitcoin. It might be electricity. And it might be their data centers. Because those same facilities can potentially be used for another booming industry, artificial intelligence. This is where Bitcoin starts colliding with the AI economy, and it gets even bigger. Level 4, the billion-dollar Bitcoin treasury strategy. There is another way to make money from Bitcoin. You don't have to mine it. You don't have to create an ETF. You can turn Bitcoin itself into a corporate treasury strategy. Companies can raise capital, buy Bitcoin, hold it, and attempt to increase the amount of Bitcoin backing each share. One of the most famous examples is Strategy. Its strategy transformed the company from a relatively conventional software business into one of the most recognizable corporate Bitcoin holders. And when Bitcoin rises, the value of that massive treasury can rise with it. But here's the fascinating part. The company isn't simply betting on Bitcoin. It is also betting on financial engineering. Debt, equity, convertible securities, capital markets, all connected to one volatile asset. When Bitcoin rises, investors may become more willing to finance the strategy. When Bitcoin falls, the same structure becomes much more dangerous. This is how modern finance works. The biggest fortunes aren't always created by simply owning an asset. They're created by controlling the capital structure around the asset. And Bitcoin has become large enough for Wall Street to build an entire ecosystem around it. But there is still one group we haven't talked about. And this group may be the most important of all. The institutions. Level 5. The real money is moving behind the scenes. For years, Bitcoin was treated like an internet experiment. Then it became a speculative asset, then a retail obsession. And now, it is increasingly becoming part of institutional finance. That's the transformation, and the latest rally gives us a perfect example. The recent surge wasn't simply millions of individuals rushing onto crypto apps. Institutional flows played a major role. U.S. spot Bitcoin ETFs pulled in roughly $1.6 billion in net inflows during the first 4 days of this week, the Wall Street Journal. At the same time, macroeconomic developments helped boost demand for risk assets. The U.S. Treasury announced increased purchases of longer duration bonds after a major bond market sell-off, while political support for crypto legislation also improved sentiment. Reuters. This matters because Bitcoin doesn't exist in isolation. Bitcoin is connected to interest rates, liquidity, the dollar, government policy, institutional risk appetite, and investor psychology. When liquidity increases, investors often become more willing to own risky assets. And Bitcoin is one of the most liquid and volatile ways to express that trade. That's why a small change in financial conditions can create a massive move. But here's the most important lesson. The people making money aren't necessarily the people who predicted the exact price. They're the people positioned to benefit from activity. The exchange benefits when people trade. The ETF manager benefits when assets flow in. The custodian benefits from holding assets. The market maker benefits from providing liquidity. The miner benefits when mining economics improve. The early holder benefits when scarcity meets demand. The company holding Bitcoin benefits when its treasury appreciates. And the financial system around Bitcoin benefits every time another wave of capital enters. That is the real Bitcoin economy. It's bigger than the coin. Conclusion. Bitcoin is pumping again. But the most interesting story isn't whether Bitcoin reaches $80,000 or $90,000 or $100,000. The real story is where the money goes when Bitcoin moves. Because every market boom creates an ecosystem of winners. Some own the asset, some provide the infrastructure, some collect the fees, some finance the speculation, some manufacture the machines, and some simply sit in the middle and take a percentage of the action. This is a lesson that extends far beyond Bitcoin. During a gold rush, the biggest fortune isn't always made by the person who finds gold. Sometimes it's made by the person selling the equipment. The same thing happened during the internet boom, during the housing boom, during the smartphone revolution. And now, Bitcoin is building its own financial infrastructure. So the next time you see Bitcoin suddenly pumping, don't just ask, how high can Bitcoin go? Ask a better question. Who gets paid every time Bitcoin moves? Because that is where the real wealth story begins. And if this rally continues, billions of dollars could change hands. The question is not whether someone will make billions. The question is whether you'll understand where those billions are going.